Here's the problem. Americans are more in debt than any other time in history. For the first time in history, the average American has a negative savings rate. The largest debt the average American has is mortgage debt. Many will never realize the American dream of home ownership. Now there is an elegant, simple solution to address this problem and solve it. Life would be totally different for most people if they had no mortgage payment. Imagine not worrying about the possibility of foreclosure. Imagine owning your home free and clear. Imagine the thousands of extra dollars you would have every month and year. Here's the solution. It's a system called reverse compounding, or as we like to call it, Reverse C. Reverse C is a unique equity acceleration system which uses sound cash flow management to completely change your thinking about owning your home. The end result is that you can pay off your home in about a third of the time it would normally take without any change in income, spending habits, or lifestyle. Using Reverse C, you still have access to your money for emergencies and expenses, greatly reduce the interest cost of your mortgage, quickly build equity in your home, are in a much better credit position, almost completely eliminate the risk of foreclosure, and you get a completely different savings approach. And the best part, the system is extraordinarily easy to follow. A word of warning. Don't fall for the interest deduction myth. Basically, you trade $3 for $1 and you are supposed to feel good because you get a tax write-off. Yeah, right. Think about it. You get to write off the interest because you gave that money away to the bank. Figure it like this. The median home, as computed by the Bureau of Census in 2004, is valued at about $140,000. If you finance 80% of it with a 6% mortgage, your interest bill is $6,720 a year. A taxpayer in the 25% bracket would save 1/4 or $1,680. That's still $5,040 that you paid to the bank and you will never see again. If your home was paid off, you would have that $5,040 in your pocket. Which do you think is better? Side by side, being debt-free is not only financially better, it's psychologically better. Here's how Reverse C works. Normally, you deposit your income into your checking account. During the time, the money sits in your account earning you nothing. The bank uses this to their advantage and earns interest themselves on your money. Then, when you do make a traditional mortgage payment, you build almost no equity in your home because most of the payment goes to interest, not principal. So, in essence, you have earned nothing and thrown away a lot of money in interest to the bank. However, with Reverse C, you are going to effectively turn this around by not letting any extra money sit in an account unless that money is being used to pay down debt and build equity in your home. An open-ended line of credit is the key to making this all work, and you will soon see just how quickly this begins to make a huge impact on paying down your mortgage. The line of credit acts just like a credit card, except the interest is much lower. With a line of credit, you are only charged on the amount of money outstanding. Here's the whole process in a nutshell. Step 1. You open a home equity line of credit or any other revolving line of credit. This line of credit will be used just like a checking account. Step 2. Make a large lump sum withdrawal from your line of credit and pay it straight to the principal of your first mortgage. Step 3. Deposit all income into the line of credit and pay all expenses out of the line of credit just like you would your regular checking account. Pay your bills as late as possible to keep daily interest charges as low as possible. Step 4. Repeat the process as your extra income pays down the line of credit. See, it's simple. You can do this yourself, but tracking the whole process becomes very difficult and many people give up. It's tough to maintain the discipline without a sophisticated tracking system. Also, you have to do the math every month to figure out the optimum amounts you pay to your first mortgage from the line of credit. Those amounts need to be right, or you could throw away thousands of dollars in wasted interest, or even get yourself in financial hot water. To top it off, you will never know when you will pay off your home without some even more complicated math. Fluctuating income, expenses, and lifestyles make the process even tougher to calculate and to stick with. Any procrastination will cost you thousands in lost interest payments to the bank. So what's the answer? The Equity Genie system. The Equity Genie software solves all of these problems and more. Let's take a look at the software to see how it works. For this demonstration, we will be using the approximate national average for a mortgage of $230,000 at a 6.5% interest rate. We have a term of 30 years, and we're going to assume this is a brand new mortgage. Our credit line will be $20,000 with a rate of 8%. The national average household income for homeowners is about $6,000 per month, and also monthly expenses without a mortgage payment is about $3,500. We're just rounding these numbers to give you a demo, but these are very close to the average homeowner's situation. Going to the Actions tab, we can see right now in the projections that by using the Equity Genie system and software that we're going to save over $213,000 over the course of the loan. Also, we'll pay off our 30-year mortgage in approximately 10 years and 10 months. Excited yet? Okay, notice the current info section. It is showing the interest saved to date. It's at $0. Also notice the interest saved number in the projection section. The projected interest saved number will work its way down to 0 as you use the system, and the interest saved to date will work its way up. The interest saved to date is the amount of interest savings you have locked in by using the system. We see in the monthly info section that we have an average available budget after all expenses of $1,046.24. Using this data, the software is calculating that the optimum amount to initially pay towards principal only of our first mortgage is $3,672.31. So let me show you how to use the software. Basically, all you do is use it like you would a check register. Income in and expenses going out. The software does everything else. The software is a tracking and discipline tool and has no access to any of your accounts or money. You maintain complete control of your finances. So we have to confirm each entry to tell the software that we actually perform the actions. Let's confirm the initial amount to first mortgage action. Enter the date that we actually did the action. Then hit confirm. Okay, now it's confirmed. We now see that by paying $3,600 to the principal of the first mortgage, we have locked in a savings of over $20,000. So as you can see, the software is pretty easy to use. All you have to do is to perform the actions the software tells you to do. The next action you need to do is flashing at you right here. We can see that the software is telling us to make a transfer from our credit line to our mortgage. This is our regular mortgage payment. We will confirm that action to tell the software we actually did it. Now, let's add in some income and expenses. We are going to go into the future and show you what happens as you use the system. I'm going to vary the income and expense entries to show the learning and adapting capabilities of the Equity Genie system. Let's add $5,800 in income. We're moving from income to the credit line on July 15th. Let's add that in. Now we have to confirm the action. Let's confirm it. And you can see now that our credit line balance is showing negative because we've paid in all of our income into the credit line. In real life, this won't happen because you will pay expenses out of the credit line first. So let's add in expenses of $3,500. So we move from credit line to expense. Also, notice the custom feature here. The custom feature is simply a way to name your entries for easy tracking. Let's just pretend that all of our bills are paid through Visa, so we'll label this action Visa. Once this is added and confirmed, we can see that the balances have all updated. The software is adapting in real time to our actions. Let's fast forward 1 month. You can now see that I have added and confirmed the regular mortgage payment and our income and expenses. Now the system is saying that because of the actions we've been performing, we need to move an extra $2,392.48 to the principal of our first mortgage from the credit line. The software is calculating that we are paying the credit line down too quickly and that we could actually accelerate the system. With $20,000 in interest saved showing, let's go ahead and confirm this action. Now look at what happened. we are up to $34,000 in interest savings. This is the actual locked-in interest savings in less than 3 months on the system. If you are not excited yet, you need to check your pulse. Okay, let's fast forward one more time. Now we have 4 months of data in the software. Remember, we originally put in a monthly income of $6,000 and monthly expenses of $3,500 on the My Data screen. What you can see now is that the software is starting to adapt to our income and expense fluctuations. You can now see that the average income and expenses have changed. Our available budget has actually gone up. Also, notice that the software is now saying that we can pay off our mortgage quicker than the original projections. Our first projection was for 10 years, 10 months. The new projection is 9 years, 9 months because the software has adapted and learned our income and expense fluctuations. This is very handy for those with income that changes radically from month to month. The software learns and adapts in real time to your real life situations as you use it. All you have to do is follow the system. You tell the software what and when and in what amounts, and then just follow the prompts. It's that simple. We've taken all the thinking out of it. All the complexities are done automatically by the software. Let's take a quick look at the other tabs. The first mortgage tab shows a complete breakdown of all the mortgage payments you make, including the exact amount of principal and interest you are paying each month and the running balance. The credit line tab works in a similar fashion. It displays the details of all transactions in and out of the credit line as well as the running balance. You can also print out this information for year-end tax planning. If you want to run what-if scenarios, we've built in a special calculator. With this calculator, you can enter various loan amounts, interest rates, loan terms, as well as income and expense scenarios to see the long-term effect of different actions without upsetting the main software data. This is the same calculator we have included in many of our web pages and marketing materials. Now you understand why we are so excited about the Equity Genie software. It takes the complex math and tracking and makes it a simple, easy to follow, step-by-step system. Here's the best part. The Equity Genie software costs less than one average mortgage payment, but returns as much as 200 saved mortgage payments. Plus, you get access to our exclusive bonus courses in real estate investment, credit repair, building business credit, and more. You also get access to our exclusive community of Reverse C users that can help you along the way. You also get lifetime technical support, so you are never alone. To get started, use the contact information you see at the bottom of this video. Set yourself free and break the hold the bank has on your life.